Thank you for joining us for our webinar update with John Moog, Portfolio Manager of the Pengana Global Small Companies Fund. My name is Lana Ward and I am a BDM based in Pengana's Melbourne office. I'm really excited to be hosting today's webinar, and it's great to see so many people registered to hear about this very differentiated strategy, which we believe is so well placed in the current environment. And I'll leave it to John to explain why. John will also provide an overview of the investment approach, discuss the factors contributing to the fund's performance, how the portfolio is positioned, and his outlook going forward. The presentation will run for about 30 minutes, which will leave us plenty of time for Q&A at the end. I do encourage you to ask any questions that you may have, and you can do so by entering them into the Q&A box at the bottom of your screen at any point throughout the presentation. So with that, I will hand over to you, John.
As Lana mentioned, this is John Moog, the Portfolio Manager of the Global Small Companies Fund. And I look forward to chatting with you guys about the small cap global marketplace and what we're seeing and what we think the opportunity set is today, and also hopefully taking some questions at the end. So I will jump into the presentation and just give a very brief background on myself as well as the firm. Lizard has been focused on the global small cap universe since 2008. I was part of the team that founded and established the business way back then. We are registered with all licensed the SEC here in the US. But the reality of our process and what we do is we try to find very high quality businesses in the small cap space under the typical institutional radar screen. Identify them, research them, and get them into a high conviction portfolio. And that is really at the core of our process, what we're trying to do, and what we think is a really an evergreen long-term opportunity set to mine in the equity space. The team is made up of four team members. Myself, again, I've been with the firm since 2008, and I'm the CIO and portfolio manager here, along with Mickey Ryan, who's been with us since 2015. Tam Phan's been with us since 2017, and it has been a little bit since I've done one of these webinars. So we've been joined by Sudhan Podar, who has been a portfolio manager in the global space for the last 12 years and has been a key addition for us. So we're really excited to welcome Sudhan to the team, and really excited about some of the skill set he brings, as well as some of the analytical tools that we've been able to put to work here at Lizard that we think help our investment process. And as a reminder, in terms of our process and what I mentioned just at the beginning about the focus on high quality businesses. Well, again, this is a bottoms-up built portfolio. We manage risk top-down, but these are the key criteria we're looking for every investment we make in the fund. We're looking for businesses that have a competitive advantage that can earn high returns on capital over long periods of time. We want balance sheets that are self-funding and able to survive downturns in the market. We want management teams that are aligned with us, and we want corporate governance that protects us as minority shareholders. So those are the four pieces of a business we're looking at, and then of course we want a compelling valuation alongside that. So those are this is sort of our North Star in terms of what we are looking for when we make an investment in the fund, and those businesses that we think can compound value over time most efficiently for our investor base. Historically, just a quick overview of the small cap universe. Small caps have outperformed large caps over long periods of time. Over the last 3 years, that has not been the case, but over a much longer time horizon, we see that small caps tend to outperform large caps by about just under 3% a year, and do it without adding much incremental volatility. So we think it's a really compelling value proposition for investors, and I think specifically right now it's even more compelling. Again, I think this slide sort of depicts the chance of you outperforming large caps based on holding periods, and we can see the longer that you hold small caps, much greater your odds are of outperforming the large caps, which take out sort of the specific short-term time disruptions that we see sometimes in the market. So with that, I just want to talk about what we think the opportunity set is today and why we're so excited about it. We've been through a period really since 2021 where we've seen small caps start to underperform large caps. And what we've really seen is as interest rate coming out of COVID, and sort of that COVID rally in 2021, and moving into a higher interest rate environment here in the U.S., we have seen small caps really begin to trade. The multiples in small caps really compress relative to those in large cap, and we've really seen small caps underperform over that time period. This chart really depicts sort of the fact that small caps tend to trade at a premium to large caps. That is largely because they have faster growth rates and higher returns on capital. But you see here at the tail end of the chart that since 2022, small caps have actually started trading at a discount to large caps, and we think that is one of the big opportunity sets we see in the market today. Is the opportunity for that to flip back to a more normalized environment, especially with rate cuts coming. The second large distortion that we've really seen grow since 2021 and the Fed raising rates is the valuation differences between U.S. and non-U.S. equities. This chart depicts effectively three different valuations. Three different indices, and the last is the MSCI World ex-US Index, which would include just developed world outside of the US. And what we see here is that from the period of, let's say, 2005 through 2015, the average multiple, or 2006 through 2015, the S&P traded at about a 10-11% valuation premium to non-US equities, which we think is fair given the return differences in the underlying companies and the growth differences in the underlying companies. From 2015 onwards, we really saw that premium expand. Over the last decade, it's been about 34%. And more recently, it's over 50%. You really see it blow out sort of in that post-COVID period as the Fed started to raise rates. So we think, again, that premium is a bit unsustainable, and we think there's a big opportunity looking at equities outside of the U.S. given where the valuations sit. This is something we've been talking about for quite a few years now, and I think one of the things that we've been asked, and it has been a fair question, is that's great. There's this big opportunity in small caps, and there's this big opportunity in non-U.S. But what is the catalyst for really get it going? Why should I care if the U.S. large caps, all that's been performing well? We think the catalyst is actually here, and it's very simple. We really think the Fed, which lowered rates for the first time in September and is now entering an easing sort of stance. We would expect interest rates here in the U.S. to come down. We really think that is the key catalyst to really unlock the value in the small cap universe and the non-U.S. universe. Here we see kind of the correlation between the U.S. 10-year bond yield and the outperformance of large caps relative to small caps. So we've inverted the yield so that as the blue line is the U.S. 10-year yield. As that line goes down, that means the yield is going up. So we started kind of with a 2% yield back in 2022, and have moved down to almost 5%. You also see that large caps have outperformed, and the correlation is pretty tight over that time period. And now that we've entered into an easing period, we would expect this relationship to maintain itself, and we'd expect small caps to really start to outperform as you get into an easing Fed environment. That is also something we've seen over time. So I think the catalyst is here, and we're really excited about the fact that we're seeing the signs of the market really broadening now. We're seeing stocks outside the Magnificent Seven start to be perform not as well as the rest of the S&P 500. We're starting to see small caps outperform large caps. All the things that we would expect to start happening in an easing interest rate environment are now starting to happen. And I think that is really what gets us excited about unlocking the value that we've been talking about. The other piece, and this is a little bit correlated, but slightly different point that we'd make is that small caps have a very long-term historic relationship with how steep the yield curve is. And so what we have seen is the yield curve was in contango, or effectively short rates. So short-term rates were higher than long-term rates, which means that the curve was inverted or sloping down. And so what we see here is that, again, this chart it looks a little bit confusing, but it's really not. The blue line at the low end or going down means that the yield curve is flattening or going into inversion, and the blue line going up means that the yield curve is steepening. So you'd have lower short-term rates and higher long-term rates. And so unsurprisingly, what we see is, again, and the gray line is small caps outperforming going up and small caps underperforming going down. And what we see, and this is a 40-year chart, and this is the longest data series we could find. So we use the US index, which is the only data series going back that far, is that small caps outperform when we see the yield curve steepening, and small caps underperform when we see the yield curve flattening or disinverting or inverting. And so we've been through a period of inversion the last couple of years, as many of you know, here in the US. And we're now, with the rates starting to ease, we've seen the yield curve disinvert. So again, we're now back into a more normal environment where you have short-term rates lower than long-term rates, which would indicate easing business environment in the short term, and we think expectations of growth in the long term. And we would expect that to continue as the Fed continues to ease. So we think another key catalyst and piece of data that would support the fact that we believe we're getting into a cycle of small cap outperformance. And we've seen that again over the last 3 months, or certainly the last 2 months since the Fed has started to ease rates. So hopefully that all makes sense in terms of why we think this opportunity in small caps is here now. In terms of our strategy and what it offers and why we think it's very differentiated, again, we offer a concentrated, focused portfolio. Currently, there are 36 equities in the book of high-quality businesses. So we have, the ROE across the portfolio is over 21%. And what we see is it's significantly cheaper than the underlying benchmark at 20 times earnings, and that's trailing earnings versus 42 times earnings for the benchmark, which we think is a bit, both of those numbers are a bit distorted, but even on a go-forward basis, the portfolio is trading at a really significant discount to the benchmark, while also having a much higher ROE, and we expect a much higher growth rate. And again, if you look at the average market cap, we are trading it, again, kind of in that small cap universe where we think the opportunity set is quite rich right now, versus a benchmark that is a bit more mid to large cap. So we think, again, it's a differentiated portfolio, and we're quite excited about our positioning as we enter the interest rate easing cycle here. Just kind of showing you the graphical difference in our portfolio relative to the index. This is an exposure effectively by market cap relative to the index. So you can see here that we're quite, we have a lot more exposure, and zero would be index exposure. So you can see we have much greater exposure than the index in that sub $1 billion market cap range and that $1 to $2 billion market cap range. And we are about 40% below the index in that greater than $10 billion market cap range. And one of the things that's kind of confounded us is that even using a SMID index, the US Anacqui SMID index, over 40% of the index is now over 10 billion, which we would sort of categorize out of our sort of sweet spot. And again, we tend to focus on that small end of the market that you can see here, and we really think that's where the opportunity set is going forward. On a country exposure basis, I think we talked about that valuation gap in the US, and here you can see that we have a lot of exposure to Western Europe, and I think we'll get into a little bit of why we think that's pretty interesting right now. But also we have less exposure to North America, and that's really given sort of the fact that we think there's going to be a rotation out of North America and out of large caps in North America, and we think that's while we've had that position for a while, we do think again the interest rate coming down here in the U.S. really driving global interest rates is going to be a big catalyst to unlock the value in where we're invested. Moving on to performance, you can see here, I think, similar to some of the other charts I've shown you, is our performance started to diverge in a negative way at the end of 2021, when you saw small caps start to go out of favor. Unsurprisingly, we've underperformed an index that is 40% weighted to greater than 10 billion in market cap. But despite that, I think again, that is who we are and as a fund and investors. But I think understanding why that underperformance has existed, hopefully the beginning of the presentation has done that. And now we're moving into a period where we think where our fund tends to be allocated is set up for a run of significant performance as things move into sort of a new environment here, which we're seeing signs of. So getting a little more into the performance drivers and the headwinds we faced and why, and what we think, what things are going to look like going forward. What have been the big headwinds from 2021 through 2024? Really was our exposure to small caps, our underweight U.S. equities, and then the last piece, which I think we haven't really delved into the data on, is an exposure sort of that high quality segment in the small cap universe. And the last thing that we've seen in small caps, which has been interesting, is sort of in large cap, you have seen post a sell-off in 2022, you saw a lot of quality businesses sell off across the board in large and small caps in 2022. We have seen the quality businesses really outperform in 2023 and 2024 in large cap, but we have not seen that happen in small caps. So what you have had is sort of this multiple compression across small caps, and we think that quality end of the spectrum is actually quite cheap right now in the small cap space, with little differentiation among the equities. So I think that we would expect that to also start to reverse and the quality start to separate itself from the rest of small caps in terms of the opportunity set going forward. What would have been some of the positives over the last 12 months, on an attribution basis, we've seen our stock selection add about 9% to relative returns. And really the driver of that is the fact that we have done a good job picking stocks in the small cap space. However, our allocation to the small cap space has been very painful. And you can see on the negative side that the fact that our allocation to that sub-billion-dollar space and underweighting that greater than $10 billion space is detracted 8% from our relative returns. And so again, we will continue to be focused on that small cap space, and we hope that we continue to do a good job on the stock selection, but we'll start to really benefit from the exposure to that space as we move into the environment as we see it today. Some of the things we've done to improve our process, just quickly, is with the addition of Sudin, is adding some better top-down risk controls that we think are important, and also bringing in some analytical tools and IP that will help us better screen our universe and use our institutional knowledge in this small cap space. So we continue to be excited about the future of the fund, and continue to be very excited about the current positioning. And with that, oh, sorry, I'm having a little tech problem here. Okay. And with that, I'd just like to get into a few examples to give you guys a sense of the kinds of businesses we buy and why we buy them. The first is Glanbia. Glanbia is the largest performance nutrition business in the world. And so they are it started as an Irish co-op milk producer, have moved into the milk industry in the US, and through a long series of events produced whey, which became the key protein in performance nutrition. So you can think about that as sort of powdered protein a lot of bodybuilders or a lot of other athletes are using today. They own one of the largest brands in the world. This is a business that we bought after margins had compressed a bit. The thesis was quite simple here. We expected margin recovery along with long-term secular growth in the underlying market, and we're paying about 12 times trailing earnings for the business when we made the investment. The investment has done okay, but has been a little bit of a poor performer recently. We have seen weaker first half performance as there's been some weakness in the consumer segment of their business, specifically on the whey protein side. And margins have been a little bit thinner than what we'd expected. And growth has been pushed to the second half of the year. On this business, it's one we continue to monitor. And I think anytime, as an example, we see growth start to slow down, we typically will give the company a quarter or two to sort of prove themselves before making a decision to move on. If we were able to confirm that there has been some type of inventory issues in the business, that would be a kind of an ad signal for us. But right now, we're in a wait and hold period with Glanbia, seeing what the next few months have to hold. Another business which we think is a really high quality business is Sapiens, one we invested in back towards the end of 2023. Sapiens is an Israeli business that is listed in the US. It is a leading software provider for insurance companies. You can think about them providing sort of the ERP or the really critical software for insurance companies. And the driver here is really insurance companies switching from in-house solutions that were really expensive to run on mainframes to modern technology. They're one of two large global players. This is a market that grows 10% a year or more. And Sapiens continues to grow with the market and take share in the market. They're also a very attractive acquisition candidate for other software businesses. So this is a business we love, has high returns on capital, very sticky revenue. The revenue is a SaaS model, very recurring, a very typical business that we would like to invest in. And so far, the performance of the equity has matched that of the business, and we're very pleased and continue to expect to be long-term holders. Baltic Classified Group, similarly, is sort of one of the hidden gems out there, in our opinion, in the market. It is a UK-listed business, but it operates in the Baltic states. So that is Latvia, Estonia, and Lithuania. And they are the number one in really all core online classified businesses in the Baltics. So that would be autos or real estate, which would be comparable to like an REA in Australia, and jobs and general classifieds. Again, this business in the Baltics, as you might imagine, is early stages of monetization. So they have a lot. You can expect double-digit revenue growth as they grow share of wallet from advertisers, much like that's occurred across the world in these assets. These guys have 75% or 70% plus market share in most of their core categories. 75% EBITDA margins, and a founder that has a significant share in the business, is only 40 years old and is looking for really to go out and create value for a long period of time. So a name we're really excited about, and I think sort of one of those interesting opportunities in the markets we operate in that have been already sort of monetized in the larger space, like an REA or some of the other US or European assets. So hopefully that has been a helpful overview of the strategy, the opportunity set as we see it today. Again, we continue to be very excited about what the future holds in terms of lower interest rates and what that means for the niche we operate in. And hopefully I've given you a flavor of what the portfolio looks like, as well as the type of companies within the portfolio. And Lana, hopefully, I hope we can open it up for Q&A and we can have a little bit of discussion at this point.
Great. Thank you, John. That was such a great update. We have had a number of questions come in, but just a reminder, if you still had any, there's still time to enter them in by the Q&A box at the bottom of your screen. Okay, let's get started. I suppose first one we have, John, we've been waiting so long for small caps to come back. Can the valuation gap between small and large actually stay as it is long term?
An interesting question. It has stayed longer than I would have expected. I think, I suppose anything is possible, but I would say looking at history, would be very abnormal. So, I mean, I think when you look at any long-term data set, small caps tend to trade at a premium. So, and I don't think anything really structurally different has happened in the market. We've had Magnificent Seven, I guess, have had quite a run, and partly to do with that. But the reality is, we have the compression in multiples in small cap has been longer than it typically exists. That being said, when we look at all the data and everything we read, and I hate to keep bringing up this point of interest rates, but you get much of the small cap outperformance in the 3 years following a interest rate cut. And so I think as we move into really what's turning into a global easing cycle, we would expect the next 3 years to be quite bright for small caps. And for whatever reason, if they're not, it would really be kind of flying in the face of a lot of historic sort of performance that we've seen over the last 4 decades.
Definitely. Well, it sounds like some of those headwinds are now becoming tailwinds for the strategy. John, your thoughts on Germany, please, and the opportunities that you see there?
I'm sorry, can you cut out for 1 second, or I didn't hear you.
Your thoughts on Germany and the opportunities that you see there?
Yeah, absolutely. So Germany is quite an interesting market for us. Structurally, one of our more well, we like German companies structurally. They tend to be well run, and tend to have good management teams, good capital allocation. That being said, we think Germany is in a very tough structural spot in Europe. I would say it's probably one of the places we're most negative on a macro basis in Europe. I think the UK and some other places have a little bit of an easier road following the energy crisis. That said, Germany should still benefit from the fact that energy prices are down. I think the issue there is the manufacturing engine that really drives the economy in Germany is a little bit, it's still trying to figure its way out of sort of the post-China slowdown. But I would expect the Chinese stimulus to help that. That being said, I think we have exposure to a couple really high quality German businesses that we continue to be excited about and think can compound value based on what I said really early in the answers, which we think are they're well-run businesses with good business models and will continue to create value.
Okay, great. On to the next one. There is a reasonable allocation of consumer discretionary in the portfolio. What are your thoughts moving forward on economic growth factors and unemployment having an impact on this part of the market?
Yeah, and I was looking at that actually. We spent a lot of time looking at our allocations and just to be a little bit cautious on that on the consumer discretionary allocation. When we look at it, we probably think that's about overstated by about 400 to 500 basis points, as we think a couple of the companies that we own are actually not that tied to consumer discretion. Which so I would say the allocation to consumer discretion isn't quite as high as it would appear. That being said, I think when you look at a couple of things happening, I think unemployment's always bad. Higher unemployment's always bad for consumer spending. That being said, we have been through a period, specifically in Europe, of very weak consumer spending. You're getting through an energy crisis with extremely high energy prices over the last couple of years that have now gone away, and economies that are actually, albeit slowly, starting to grow again. We think there are actually a lot of places in the world where consumer spending will improve. The US is one place we'd be a bit cautious on consumer spending, but we think the Chinese stimulus as well as will help spur consumer spending in Asia. And we think in Europe, things are actually starting to look a little bit brighter on the consumer spending front than certainly was the case 12 months ago.
Okay, great. I'm going to combine a couple of questions here. Are there any themes that you are particularly excited about at the moment? And conversely, from a diversification perspective, are there any industries that you are significantly underweight?
Sure. There are a couple of things that I think we're excited about. I think themes that are interesting right now. Two, I'd say we're excited about. One, we're still trying to figure out and think about. I'd say the first theme is in Japan. We overall are still excited about the corporate governance improvements in Japan starting to trickle down to small caps. That is, I think, going to be a long-term secular theme. But more importantly, when I spoke earlier about these quality businesses trading down in multiples relative to the rest of the small cap universe, that has really been the case in Japan. And you've seen a lot of domestic Japanese companies that are very high quality trade, that are growing really, multiples really compressed as the yen weakened over the last couple of years. And so we think there's a really big opportunity in Japan for quality domestic businesses to perform really well coming out of this. And I'd say that's one area where I would say that it looks really ripe with opportunity, if you will. The other place I think is the UK small cap continues to be an area we think is really interesting. You have improving and a better than expected economy. Energy prices have come down, and we're seeing across in kind of a macro level, earnings estimates start to go up for a lot of UK businesses. So I think that's another place or theme that we think is compelling. The place we're watching a bit right now is China. The stimulus, announced obviously drove stocks quite quickly, but I think we're trying to take a little bit of a longer term view and see if there's a big opportunity in China or not, and honestly have not figured that out yet. And the last, I think the last question: are there any areas we're really meaningfully underweight? The areas we're most underweight, and this is more structurally to do with how we invest, is we tend to be underweight materials, tend to be underweight, and real estate are the two areas of the market which, materials, we tend to not want to be too tied to commodity prices. And real estate, we tend to stay away from sort of highly leveraged yield plays. We tend to stay, given that kind of focus on balance sheet. So those tend to be two areas of the market we're underweight. I would say that's more of a structural issue for us than anything, any negative comment about those particular industries.
Okay, and I guess expanding from that answer, why don't you invest in the banks?
Yeah, banks, so we invest in a lot of non-bank financials, and we like, we don't have a problem with financial companies. Banks, by and large, and in a lot of places of the world, the bank structures are different. I think in Australia, where you have a pretty concentrated banking environment, they tend to be very stable, reasonably good businesses. In a lot of other places in the world, we tend to find them to be very low return on asset businesses that need quite a bit of leverage to earn a good ROE. And what we found, especially in the U.S., it's a very competitive place, and being a bank is a tough place just given the number of banks. And in other places of the world that can be cyclical, owning a leveraged bank in a downturn can be a very good, easy way to get your equity wiped out. So we tend to stay away from banks because they are highly levered, and we don't think they're very high return on asset businesses over time.
Okay, good answer. John, you've been overweight to Europe for some time and it hasn't worked for you. Why do you think now is the right time?
Yeah, I mean, I think it again, we think that I think we've been talking about the interest rate catalyst for a while. It's finally here now. Yeah, we certainly were early and wrong for quite a period of time. But we do think interest rates easing here in the U.S. Will have kind of multiple layers of value creation for non-U.S. equities. The first, just on a currency translation front, we would expect the U.S. dollar to weaken. Secondly, we would tend to think the environment in Europe is getting better from an economic standpoint, for the reasons I've talked about. So again, I think a lot of it's tied to interest rates, but again, you've had so much capital consumed by a very small portion of the S&P 500 that's really been sucked out a lot of other places in the market. And we would expect capital allocators, as they start to underperform with the Magnificent Seven, which you're seeing now, really start to look at other places to allocate. And as you see that sort of capital allocation start to move into other places of the market, we would expect non-US to be a key beneficiary of that, from sort of that re-rating perspective that we think is out there, given the huge discount in valuations relative to US equities.
Okay, great. Thank you. Can you explain your improvements in the universe screening in a little bit more detail? I know you mentioned it high level before, but expand on that one a little bit.
Sure. So yeah, I mean, effectively, and I will try to keep this very brief. But if anyone really wants to see it, I'm happy to do it offline at another point. But effectively, what we have built out is a database of 20,000 companies around the world, that has about 15 years of history to it. We think it's a totally unique database, but it really categorizes businesses by sort of growth and quality, comparing them to the rest of the market, and then goes through the universe, and then would look at sort of the higher growth, higher quality businesses, and highlight the ones that have the attributes of the best performing equities in those categories. And so it allows us to go across the universe really quickly and identify what we think are the highest quality businesses, with the traits that tend to lead to equity outperformance. So that's something we've built and we're now implementing. It's additive to our idea generation, and it has been very helpful. So I think it makes us much more efficient from an idea generation and a return on time standpoint. So it's something we're excited about and think will help drive the process moving forward.
Great, thank you. It sounds like there's a lot of good opportunities there. Um, are small caps cheap or are large caps just expensive, or a bit of both?
So I would say there's a segment of large caps that I think are very expensive. I'd say broad brush, large caps are not all that expensive if you exclude those equities. And I think small caps are absolutely cheap. When I look at our portfolio, we tend to look at it on a go forward earnings basis. But for a 20% ROE companies growing double digits, our portfolio is trading at under 15 times earnings, which we think on an absolute basis is very cheap.
Okay, great. Thank you. And last question, and this one's from me, so a perfect segue actually. Myself and a number of people in the distribution team have been receiving a lot of questions on the small cap space. Could you give us 3 reasons why now is a good time to invest in the sector?
I think the 3 reasons I would say, number one, getting your starting point right is always helpful. And so I think the starting point of small caps being both absolute and relatively cheap by historic standards is a really good starting point. And 2, from a timing perspective, I think you have the catalyst is here now with interest rates. So I think if you get 1 right and you're lucky enough to get 2 right, the catalyst, that tends to be a really good start. So I think both of those things are true. And then I think the third piece, which is most important from sort of what's actually happening in the market, is you're seeing the market start to broaden right now. We've seen it. So if you look at sort of an equal weight S&P 500 versus a actual weight S&P 500, for the first time in probably 5 or 6 years, you've seen the equal weight outperform, which means a broad section of the market starting to outperform the narrow section that we hadn't seen for a while. Just today on Bloomberg, you're seeing all sorts of talk about small caps starting to outperform in the Russell 2000. So, in my opinion, you're actually starting to see it happen in the market. So I think when you have a good starting point, a catalyst, and evidence that the catalyst is starting to work, I think those are all, those would be the 3 reasons I'd give you that to be excited about the space.
Okay, great. Thank you. In the interest of time, I'm going to wind things up there, but thank you, John, and thank you to all those that submitted questions. We weren't able to get through all of them, but for those of you who didn't hear your question or a version of your question, we will respond to you directly. What I really took from today's presentation is, notwithstanding the headwinds small companies have faced in particular, the fund has remained true to label, and there's still meaningful growth to be found if you know where to look. And that's certainly the case with John and his team. Our next webinar in the series will be next Tuesday, the 22nd of October at 9 a.m. And that will be on our Axiom International Ethical Funds. Please RSVP for that one if you haven't done so already via our website. And with that, thank you again for attending and enjoy the rest of your day.